Okay, so today we'll start with the first topic of our CFA level in equity. It's called market organization structure. Now, basically, in this topic, we'll understand how the markets are basically organized and structured, and who are the players in the market, what are the various players, and so on. And we'll try to understand the various dynamics of the equity markets, and also how do we structure products? How do we make investments? Then we go on to the next part where we do valuation. We try to understand equity securities and what are the fundamental factors that go into valuation of stocks and shares. All right. So the first part of it is on market organization structure. Before we start, please remember, always look at what the learning outcome statements are. These learning outcomes are useful from an exam point of view. The CFA curriculum looks at learning outcomes to test your knowledge. So when we say explain, you should be able to explain the functions, describe the classifications. We look at types of securities, currency, and so on. What are the various types of these commodities, currencies, and understand their key features, right? We look at types of financial intermediaries, compare positions, and the leverage ratio, and so on. Okay. Then we look at comparing execution, validity, and so on. Market orders, we pick up what type of market order, limit orders, or stop orders. We'll do different types of markets. We look at what the feature of a financial system are, and also we go on to a bit on market regulation. Now, broadly, for a financial system to be successful, for a country's financial system to be working smoothly, there are three broad purposes. Okay, three purposes. One, making sure that it achieves all the purposes of what the financial system is. Why is it set up? Essentially, if you see any country, a financial system is something that will ensure there's liquidity, there's lending, there's borrowing, there's transparency, there's liquidity in the market. So the financial system should ensure that it's achieving the purposes. And obviously to do that, we have the regulators, we have the various intermediaries, like we have the RBI, we have the SEBI. All of these are the people who are making sure that these purposes are being achieved. So that's the first function of a financial system, making sure that the overall functions and objectives are achieved. The second one is making sure that you achieve the equilibrium rate of return. Equilibrium rate of return, it means the rate at which the markets are in equilibrium. If the rate of return being earned in the market is anything over or under, then there will be a lot of corrections. And corrections eventually lead to equilibrium, right? So we want to make sure that the markets are not going like this, but they're going more of like this. So because they are around the equilibrium rate, which is the appropriate rate of return. And the functional market is make sure that you not just achieve it, but keep discovering that and stay at equilibrium. The third point is ensuring efficient allocation of capital. Now you know that capital is limited, right? Not that you can print money, correct? Printing money is obviously going to be better than inflation. So money can't be printed. So what is the main purpose? Making sure that the limited capital is being used efficiently. And this is most critical. We want to make sure that the capital is being used in the right purposes for the development, for achieving the overall objective of enhancing the economy. So this allocation of capital should not go into non-productive purposes. If you remember there's a ban on betting apps and games and so on, right? Why did that happen? Because the economy, they realized that a lot of money was flowing into betting, casinos, and other aspects. So those are non-productive purposes. So the government decided to pull them up, have a ban, and that would prevent capital being allocated for the non-productive use. So what are productive uses? Things like investment, real estate, stock markets also to an extent are productive because you invest in companies who are further investing in the infrastructure. So those is where what you want to ensure. Capital should be allocated in the right places, right? So quick summary, what are the three main functions? Achieve the purposes which the regulator help achieve, discovering an equilibrium rate of return, and ensuring that the capital that is limited is allocated efficiently. Okay, so this slide simply illustrates what we just discussed. What are the broad functions, as you're already aware, of the market? Okay, lending, borrowing is obviously the biggest function. Apart from that, we want to make sure that Mopping up equity capital example, if you have extra money, then what we do? Either you put it in bank or in the stock market. So the stock market help you to mop up the capital and invest for the future. Transferring assets for current and future deliveries and obviously trading. This is the broad 6 purposes that the function of the financial system. Equilibrium return is basically the rate at which your total lending is equal to the total borrowing rate. Okay, so we want to make sure that the balance. Today, if you see our FD rate is around 7.4%, our borrowing rate is around 7.9%, right? Broadly the best ones. Now there's a margin of 0.5. Why do you think the difference is existing for if you invest, if you borrow? Obviously you borrow high because the margin is for the banks and the intermediaries who are arranging the funding. So this is basically trying to make sure that we maintain an equilibrium rate at which borrowing and lending would match each other. Okay, this balances the demand and supply. And you already know concept of economics that demand should equal to supply. So that gives me an equilibrium rate. You'll never see that the rate in the market is probably 7%, and if you borrow, you'll get 10%, right? That is not equilibrium. Correct? So that's critical. Third, which we discussed, it is allocation towards productive uses only, which explains what I just told you in the earlier slide. Making sure that it's for the right risk and right purpose. When I say allocated, I need to say that make sure that your R equals to R. What is the first R? Risk. And the second one, rewards. Your risk should match rewards. Therefore, if you invest in risk-free, you get a lower reward. If you invest in risky, you get a higher reward. Risk should equal to reward, which is your allocation of capital and balancing the equation. Clear? So this is a high-level summary of what the financial system and its functions are. Any questions? Guys, please feel free to mute yourself and ask any question if you have in the relevant scenario. Right. So now let's go to the different types of assets. Right. So broadly, there are two types of assets, guys. One is financial assets. You have financial assets which are in money terms, broadly financial, and you have real assets which are more of hard assets like commodities, real estate, which is not directly in money terms, right? But they can be converted to money. But these are financial assets, are those which are directly convertible or easily measured in terms of money. Clear? What are the financial assets per se? Now, within financial assets, we have investments, we have securities first. Okay, so more by financial securities, which comprises debt securities and equity securities. Okay, pooled interest obviously is a mix of the two. So we have debt and equity under financial securities, and then you also have pooled investments. Now, debt securities, I think you have already covered in the earlier few chapters. This is completed. This is all security in the form of fixed income and fixed duration securities. Equity securities are small securities which are in the form of equity shares of companies, right? So equity is what we'll cover in this part of the topic. Entirely we cover equity and valuations. These are shares of companies, right? And pooled investment, nothing like mutual funds, so on, which pool the money. This is on the financial security side. Then we have currencies. Currency is nothing but all your currencies like US dollars, your pound, your rupee, and so on, euros. These are currencies which are being dealt with. You also know this currency market where the currencies are being bought and sold, right? So that's also a form of financial asset. Then we have derivatives. We have a separate topic on derivatives for the CFA exam, where we cover things like futures, forwards, swaps, options, and so on. Swaptions, and so on. These are nothing but assets which are deriving their values from another underlying asset, right? So this is the third category. The fourth, and broadly there will be other alternate ones. Then in real assets, we'll have broadly the one that we've seen, that is real estate part, which real estate pertains to obviously investment, property, could be commercial, could be residential. So any investment that I'm making in real property is called real estate, right? This is the physical tangible properties. And commodities obviously are things like copper, gold, silver. Today you see the big focus on silver price going up, gold. This is all your commodities, right? You can invest in real silver, real gold, or digi gold, digi silver. But that's all commodities for you. Clear? These will not come within financial assets because these are not directly convertible to financial terms or money terms. These are things which are more of real assets for the longer term. Okay. So are we clear the broad classification? financial real. Okay. Each of this will broadly be a topic for a CA clip. We'll cover in real estate and alternative investments category. Clear? So this is a broad asset categories. Okay. Now let's quickly come to types of markets. Now in the financial markets, we have spot markets, we have future markets, we have forward markets. So broadly, just a understanding of which are the markets that exist and what are the feature of these markets. Each term is important. Please make sure we understand each term. The spot market, as the word suggests, is where you can buy on the spot. You can buy and sell immediately. Okay. So the delivery of whatever you are doing is on the spot and with immediate effect. So therefore we call that the spot market. Obviously, the opposite of that is called the forward market, where we can buy and sell, but with an obligation or a promise to buy, deliver at a future date. So this could also mean a future markets of commodities or option market, where you're undertaking to deliver or exchange money at a certain future date. So these two are basically in terms of timing of completion, right? Then we have primary and secondary market. Now you'll know this answer. Primary market is where all the shares are issued for the very first time. Clear? And here, basically, the best example is IPO. Everyone knows IPO market. So when a company comes for initial public offer, this is called a primary market. Why? Because the shares are new. It was never traded before, right? And this is a fresh issue. And the best part is this is done by the company, right? In the secondary market, this is where the shares are already traded, already existing. So we trade the shares with each other. That is called secondary market. Are we clear? So primary is IPO and secondary is what happens in the share market regularly. Then we have the money market and the capital market. The money market, as the name suggests, is money, which is more short term. And this is where everything with a less than 1 year maturity is being dealt with. The moment the maturity goes to more than 1 year, that gets traded in the capital market. So when you look at shares, debts, preference shares, and so on, debentures, bonds, when these are traded for in the market, it will never be in the money market, they'll be in the capital market, which is why we often say that capital market is where IPOs and all take place, right? Because those are investments which are over 1 year. So when the investments or the instruments have a duration of less than 1 year, they'll be money market. Example would be your short-term bank loans or bonds or anything that's less than like treasury securities, gilts. In the US, we have the treasury securities of the government of America. Those are issued for 30 days, 60 days, 90 days, 180 days. Those are all coming with the money market. Clear? When it's more than 1 year, it becomes capital markets. Then we have traditional and alternative. Traditional is what you believe in traditionally. You know the normal equity, debt, money market, mutual fund. Those are traditionally traded stocks and investments. Alternative is where it is everything apart from traditional. And the best example is hedge funds. Alternative investments, let's say index and real estate. Anything where you're dealing which is not a traditional investment vehicle, like private equity also. Private equity is where we have people who invest privately into a company. So it is not happening through the stock market. It's not happening through a traditional method. So alternative and traditional are different. Obviously, you will have a separate chapter on alternative investment in the CFA curriculum. That's for almost 6% of the curriculum. There we cover in more detail on which are the alternate investments and how do you value them. Okay. Hedge fund is the most critical one out there. Are we clear? So these are the type of markets which normally operate in any developed economy. Clear? Okay. So let's now move on to the next part of things. We've already covered this in the earlier part where we said pooled investments, we have currencies. And don't worry, many of these topics will be picked up as and when they sort of keep repeating. We have CDS, which is credit default swaps, and we have swap contracts. Do remember, guys, before we go into more detail, do remember in the CFA Level 1 curriculum, the intention of this entire curriculum and the exam is to make sure that you guys know broadly all the concepts under this financial investment world. So you should be wary of almost these terms that you pick up. You'll find we have discussed almost 200 to 50 concepts within this curriculum. And that is the objective of this exam. Because as we go to level 2 and 3, they will then pick up a few of these concepts and take it in more detail. But in level 1, you have no option but to make sure you know every possible term and condition and features for these aspects. Clear? So please learn as much as possible in terms of words. Let's say we are CDS. What does CDS mean? You should know broadly what CDS is, what are features, what are risks, just a broad idea. So every new word you come across, please ensure that you understood it. Maybe Google a bit, read on YouTube, apart from what I'm discussing with you also. Clear? So that's critical. So we'll come back to where we were. So I told about mutual funds, this is pooled investments, we have currencies. CDS are contracts. Now CDS, credit default swaps. This is nothing but a swap contract where if someone defaults, you will be paid the money from the insurance provider. So you're taking an insurance against the default of a person on account of credit. So example, let's say Vijay Mallya, he fled the country, he owed money to people. So because of that, if someone took a credit default swap against him, his default would have paid you the money from the person who sold you the swap. Obviously, in return, you're paying this person a certain amount of premium. So it's like taking a protection against a default of a third party. How fantastic is that, right? So this is an insurance contract which effectively got created during the 2008 crisis. Then we have the swap contracts where we swap liabilities, we swap currencies, we swap interest rate. Let's say you have a fixed rate, you want to go to a floating rate. You can swap that through entering the interest rate swap. If you want to swap dollars for Indian rupees, you can do currency swap and obviously equity swapping shares. So this again is a contract which helps you to enter into an asset or position that you're preferring compared to where you already are. Okay. Obviously, financial markets will never work without having the right intermediaries in play. Right? Intermediaries are people who are basically helping you conduct transactions in the financial markets. Right? They are the middlemen. They are the people who will assist the buyers to meet the sellers, make sure the buyer gets the right contracts. They are the people who will make sure that everything is happening to ensure the smooth transactions and obviously allocation, which again, if you remember, was the purpose of the financial markets, right? So these intermediaries are middlemen who are transferring funds from savers to borrowers, transferring money from borrowers to savers, helping the entire cycle of capital flow through in our economy, right? Apart from that, they also help to manage and reduce risk. Suppose tomorrow you want to invest in a company where you can't invest on your own, maybe the exposure is big. So the middlemen, like mutual funds, will collect money from everyone, put in one pool, and they'll invest on your behalf. So that's pooling of funds and pooling of risk. So intermediaries are very critical for the efficient functioning of the market. Are we clear? Okay. Without them, the markets would not really perform. The non-market, the entire system would not perform in them. Who are the broad intermediaries, guys? So we have brokers, dealers, exchanges, right? Brokers are people who help you in everything. Brokers are for everything. If you want to buy a house, take a house. You want to buy instruments, assets, you have a broker. The broker will be the one who will help you to buy and sell assets. You also have dealers based on where they operate on exchange. The National Stock Exchange, the BSE in Bombay, in India. Abroad, we have the various markets, the financial markets, the US markets. We have the SEC overseeing it. We have the NASDAQ. We have the New York Stock Exchange. So every market in every country will be there as an exchange to help you buy and sell assets. We also have securitizers who are people who bundle assets and then they sell it. Securitization word, if you remember, comes from 2008 crisis, where bundle of assets were come together and they created new financial products. Yep. Then we have depository institutions who convert your assets into depository slips, right? We have insurance companies who basically take the protection, they give protection against insurance, life, marine, CDS also form insurance. We have arbitrageurs. The concept of arbitrage basically is that any arbitration opportunity, let's say arbitrage, let's say there's a risk-free opportunity to make money in the market. Obviously, everyone is grabbing, right? So arbitrageurs will make sure that if any price difference is there, whereby someone is earning a profit for taking no risk, someone's just making industry profits, that's called an arbitrage opportunity that gets exploited and gets completely removed. So arbitrage will make sure that such opportunities are not existing. Otherwise, the people in the market will start making profits for no risk and the markets will go into a turmoil. So arbitrage are a very critical part of our markets, intermediaries, and they take sure of that. Clearinghouses and custodians, they are the people who make sure that all your trades are cleared on time, all your positions are settled. All the custodians are the ones who take care of the custody of your assets. If you bought a share, they'll take the custody, give it in your name. If you sell the share, the custody of the shares and instruments is given away to the new buyer. So they will make sure that the position is cleared, the custody is given, and therefore they will ensure that risks are taken care of in the world of buying and selling of assets. Here, so these intermediaries, as you're looking at the screen, are people who are making sure that the markets are performing properly, the risk is managed, the capital is allocated effectively, right? And basically, the markets are moving in the direction of the purposes for which they are achieved. Clear? So this will give you a better idea of why they are so relevant to the entire course. Okay. Let's move on to the broad category of these people. Sorry. So, who are the brokers? The brokers are like, you know, the people who fill the orders. So we have broadly three types of brokers. Floor brokers, they're the people who work on the floor. And normally, these people will not be a direct broker to you. They will act as brokers for other brokers because every broker will have to go sub-broker. So they'll be on the floor making your trades. These are the block brokers. Now, block, as the name suggests, are the people who will believe in block trading. They will move a large block of trade, right? Now you do know, like say suddenly tomorrow someone buys 10 crore shares of Reliance or any other company, right? The share price suddenly go up because someone bought 10 crore shares, someone sold also, but the purchase or sale would effectively increase the share price or decrease it. So when you do block trade, this is a very good thing. They'll move a large trade and they won't let that impact the market price per se because it will not artificially inflate. So let's say a promoter wants to sell 10 crore shares tomorrow. The share price might suddenly move up or move down because he's selling that many shares. But in a block trade, he will make sure that he will not move the market, right? And what he'll do, he will conceal the intentions of the clients and they'll make sure that this large trade is placed and not disrupting the market. Very important term. So very often when you go on the share market, you'll see certain block trades were entered on the stock market, right? And that's called a block brokers. Then you have broker dealers. Basically, they are people who trade on account of their clients and their own. They are the people who are dealing with you, dealing with their own share. They are the ones who do most of the transactions. Okay, they can work on their own as well. Okay. Now, also you do realize that when you do other people's and your own trade, you might have a conflict of interest. Now, that is something that should be dealt with and that should be factored. Okay. So they make sure that these people are not conflicted with that interest. Security broker is a person who provides security, which is also called margin facility, right, to other institutions. And he also called as prime broker, right? So basically, he is making sure that funding is available for the buy and selling of shares. Okay, this is the category of brokers, dealers, and exchanges. Okay, so the brokers are the people who help you fill the orders. They have floor, block, and broker dealers. Clear? Those are the brokers involved in this transactions. Who are the dealers? The dealers are the people who act as a counterparty. Okay, so now we're dealing with the dealers part of it, who act as counterparty. They will be the people who ensure that there's sufficient liquidity. See, the broker will probably help you to buy, sell, and get your trade placed, put it. The dealer will try to do an additional task. He'll try to provide a liquidity also in the market. So if we see that someone wants to buy, sell shares and no one's buying it or selling it, he'll try to see if he can do it on his behalf through his funding or through other clients. He'll try to infuse additional liquidity. Okay. Also, we already discussed that there is a concept of broker dealer on the earlier slide. So we have brokers who are dealing with, who are making sure the things are placed, and the dealer who's trying to make sure that the trade is effectively executed and there's liquidity. Then we have investment banks who probably are the ones who give advice to companies in buying selling shares. They're the ones who do the initial IPO, FPO, and so on. Okay, investment banks are a big offshoot of the CFA of people. Exchanges, right? The third one, exchanges are nothing but the platform provided by the exchange, like the New York Stock Exchange, right? We have the NASDAQ, this is the US, we have the BSE, NSE, all these are exchanges where they give you a platform to trade on. Yep. Okay, please learn these concepts very carefully. Obviously, apart from that, we also have alternative trading systems. That's fine. That's basically where we have, apart from exchange, we have another alternative trading platforms. Okay, so now we are done with brokers, dealers, and exchanges. Correct? Now, brokers, broad things you still confuse what the difference. Brokers act like an agent, correct? They'll be an agent and they'll make you do the trade. They'll arrange the trades for you. They do not trade with their clients. A dealer on the other side will help you get a trade, and for all you know, he may also trade with you. Maybe he finds what you're buying is used, what you want to buy is not available or not getting. He may try to arrange it through his stock, his portfolio, or maybe what is selling. If you can't sell, he may buy from you and deal with you directly. The broker would not do that. A dealer would do that. A dealer who does that is called a broker dealer. Clear? So that's one main difference, and do understand that the market should allow such people. Okay, there's a license required for that. Now, who are securitizers? We know this under the it happened in 2008, where let's say you have EMI loan of 1 crore. If I collect 100 such EMI loan people and I make a SPV out of it, right? So I have a SPV of 100 crores. These are loans and these are paying me money basically. I might issue securities of, let's say, 1 lakh securities, maybe some thousands of securities, and I'll issue these securities to customers who want to invest in these amounts. The people who will buy these securities will get an exposure to this 100 crores of EMI, which is also backed by houses. When these people pay the EMI interest loan to these people pay the amount to these guys. So these guys effectively are getting maybe 9% return on the EMI loan payments, and they also secured with the house that these people have secured. This is called securitization, where I'm taking the securities, I'm securitization the security into one package, and I'm distributing it to different investors who will then get an exposure to this security. Here, this is called securitization. What they do, they collect around 100 loans, put them into one pool, and that pool is then repackaged and sold to 10,000 different investors. So here, what are we doing? We are simply behaving like a middle link, collating, distributing, collating, distributing. Here, this is exactly what led to the 2008 crisis, the concept securitization. Now we have depository institutions. Make a quick note of that. Make a quick note. That's a very important concept. Securitization. Now, depository institution. Depository institutions are the depositories, basically any institution which is raising money from depositors and other investors. Okay, so basically they are the ones who are helping services like checking deposits, lending funds. There are people who work on the depository side of companies. These are institutions. Insurance company, I don't really need to talk much about it. All of you know. These are companies which basically sell insurance. They will protect you from a certain event. That event could be anything. It could also be credit default swap, where I'm telling you that in case there's a default of a person, I'm protecting you from the default. I will pay the full money to you. You pay me some premium. So in life insurance, what is life insurance? You are insuring yourself against the life of the person If the person dies, then the insurance company will pay you the full amount of promised amount. And you pay every year a premium, right? Fire, marine, all that. So what happens is these are the people who will help companies offset the risk that are there. So like life and marine, you also have default insurance, payment insurance, you have insurance with the financial world, price insurance. If the price falls down, you are protected against that also. You can be protected against anything in the financial world which is covered by insurance companies. Clear? Now, do remember there are three problems that these companies will encounter. Clear? One is the hazard, moral hazard problem. Suppose someone takes up insurance, then he'll be more relaxed, more chill. He'll be more risky also, right? Example, someone takes up a motor vehicle insurance. Obviously, they'll probably not be too, they'll be careless. They might say, I don't mind if the car is hit, I'll still get my insurance money, right? So those are people who might be more careless because they already have insurance, right? Which is natural behavior. So same way here also, in the financial world, if someone takes insurance, he may end up taking a much higher risk than warranted. And that is probably not good for the system. So that is called as hazard, moral hazard. Morally, you're trying to act extra risky than you should be just because you are protected. Clear? Second one, adverse selection. Adverse selection means people who are most likely to fall to a risk start buying the insurance. Okay, basically it's nothing but you're selecting the wrong clients as your insurance. Example, have you ever seen a life insurance company giving insurance to a 70-year-old? Right? Obviously, they don't insure above 65 or 70 because they know that the risk of death is more and therefore the client is not the right client. They always insure 40, 50 max. They won't give it. And obviously, the younger person, then they'll give more lower premium and all. So insurance is always about selecting the right clients. I mean, if you have an adverse selection of clients, then you have a risk, and that is a risky part, right? Fraud. Fraud obviously is a big risk, and you know this. Example, there have been several people actually fake their own deaths also. There are people who life insurance company for 5 crores, then they fake the death, they took a death certificate, and then their wife submitted that, got the money, and then they went to another city or country. Right? It's happened a lot. It's very common in many cases that were exposed. So fraud is possible in even the financial world where we say, I'm protecting myself against losses. You report a false loss and you claim the money when actually a loss never took place. Right? So you can connect the dots, right? So that is how it goes. So these are the three risks or problems of every insurance company. Here, moral hazard, adverse selection, and obviously fraud. Are we clear? Please understand the logic and the concepts of these examples. Category 5 are the arbitrageurs. We have discussed this. The people who make sure that you are not making extra profit without taking risk. Okay? The arbitrage can be time or geography. Let's say time arbitrage. Suppose today if I went and bought something, right? The same asset, I bought it now and I sold it after, let's say, 1 hour for a higher price, right? Arbitrage where I'm saying I'm just buying it and selling it after 1 hour and I'm making a profit. That's not possible, right? But that is possible where maybe the spot price and the forward price are different. Let's say the spot, today's price, right now the price is, let's say 100. And you also know that the forward price tomorrow is 110. So what if you immediately go and you buy this today and you also sell this? You buy the spot and sell the forward, you are making $10 for doing nothing, right? Obviously, that's not possible. The spot is 100, the forward will also be like 101 or something, or 100 point something, because it's a time value of money. It can't be $10 maybe 1 month down the line. That means there's a time arbitrage. You'll immediately buy this, sell this, and you'll be sitting making $10 for doing nothing for 1 month, which is wrong. 10% return can't be there. So when you're buying, selling assets at different point in time and making profits, that's what time arbitrage. Same thing will happen in geography arbitrage. But you remember, it's different point in time, the same point in time, right? Example, all of you iPhone fans or the technology fans, if you go today, let's say you go to US and you buy an iPhone, you may get for 60,000 rupees or something, 70. The same phone if you get to India by flight, sell it you get 1 lakh. You make 30,000 profit on the spot. Geography arbitrage. Obviously, that's not entirely possible because if you buy more than one phone, or if you buy, you have to pay customs duty. That duty is equal to 20,000, 30,000 rupees. And that difference removes your profit. So obviously, you can't just go and buy 10 phones, sell it here. Other everyone's not doing that. If you buy 10 phones, you'll pay duty. But geography arbitrage is that today I can buy one phone for 70, sell it for 1 lakh. Obviously, the difference is also in terms of exchange rate, right? And that will exist, but only with a reasonable amount. Clear? And that is called geography arbitrage. Different geographies, same time. If it's different time, same geography, that is time arbitrage. And different geography, same time is called geography arbitrage. Category 6, we have the clearing house. Now, clearing houses, we discussed that, are the people who arrange funds and provide sorts of clearing. They make sure that capital is adequate. And basically, they make sure that all of positions are clear. See, tomorrow if you buy or sell shares with someone, you should not be concerned, will that person pay me the money? Will he back out? That sort of gets taken care of by the clearing house. They make sure that the counterparty risk means the risk that the other side, the other party, is not going to default on the obligation that was committed to you. So that counterparty risk is mitigated by the concept of by the clearing houses. Are we clear? Okay. Counterparty risk. Now, what are the names of the various positions that you can take? Okay. Now, this is very straightforward to understand, but note the words carefully. Suppose you go and buy. Okay. When you buy, you're always in a long. Long means you have bought. Remember this word carefully. You have bought. Okay. So suppose you are the purchaser of an asset today. I'll say you're in a long position. Suppose you sold something that you don't have. You are called as a short position. Suppose you want to short something, it means you're selling something. So long refers to buy, the same way short refers to sell, right? Now, when an investor owns the asset, he'll sell the asset owned. It's called he's shorting a position. But remember, shorting the position is different from short selling. So when you short, it means you bought shares, you sold shares. So you went long and then you went short, right? Long and short. But when you sell something that you don't own, that is called short selling. Okay. Short selling is basically where I don't own a share. I say, let me sell it now. But obviously you have an obligation to buy it back, right? You can't just sell something you don't own without buying it, right? So there's a concept in the financial markets where they say that we will allow you to short sell something without buying, but you will have to buy it at a later point in time. And that later point depends on the country. Like in India, we normally allow short selling only within the day. So at the end of the day, you have to end up buying it. Maybe in some exchanges within a week, right? It's a danger position. So we know what the long position or short position. What's a hedge position? A hedge position is where you take a short and long position in different assets, right? To hedge your risk. You buy one asset and you buy another asset and you sell another asset and you make sure that your risk is hedged in such a way that maybe if that goes up, this will go down. If that goes up, then this value will go down and you are effectively reducing your risk. So when you hedge yourself, you're trying to avoid the risk from the certain position. Here, we call it a hedge. Now the word leverage, what does the word leverage mean? Leverage means when you buy something by using borrowed money. Okay, leveraging as a concept means I'm leveraging my position. I'm purchasing something by using borrowings, right? So the term leverage means borrowed money used for purchase of an asset. Yeah, obviously it's a good concept, but it's not too good because if you're borrowing money, let's say at 10% and earning 30%, that's amazing. But if you borrow at 10 and you're earning only 7%, you end up being in a loss. So it's important to make sure that you understand that leverage position is a very risky bet when the returns that you get on the position are less. Yeah.
So can you talk about a bit more about short selling and
Sorry?
hedging? Can you talk about short selling once again?
Yeah, I will. Good question. I'll just go to the next slide. So it's anticipate that you ask for it. I will. So what is short selling? Okay. Now, after this slide, let me know if you still have more questions. Short selling as a concept is where I don't own something, right? I have not bought, but I feel the price is going to fall. Let's say Infosys shares. I know Infosys shares are not 50, but I have a feeling because some fundamentals, the share price will fall. So if it's going to fall, obviously it's better to capitalize on the fall by selling it today at a, let's say 1500, let's say it is 1500, and I say the price is going to fall to, let's say 1200. I feel that. So I want to sell at this price and consider buying at this price so that I make a profit of 300 per share, right? So if I do this for 100 shares, I'm going to make like 3,000 rupees for nothing, right? But I can't do this because I don't have the shares. But the concept of short selling allows you to go to the market and say, okay, dude, I want to sell this without buying it, but I will buy it back within the next 1 week or 1 month. So you go to a market and you place a sell. And then you say, I'm going to do a short selling, which is selling something without buying. And the market will allow you to do that. The market will not obviously give you money. It will simply put a credit for this amount, right? And you'll have to put a margin, obviously. And now today, effectively, you have probably sold, let's say, 1,50,000 rupees worth of these shares. Okay. Now, remember you to buy it back. So you will wait. You will wait for the market to react. Let's say it did fall, right? You need to go after 1 month and buy it back at 1200, which means you have to now only pay 1,20,000, but you already have 1,50,000. So the market will pay you 30,000 rupees and close the contract. It will pay you 30,000 rupees and close the contract, and you made a profit. So you were able to sell something without buying. Okay. Now, and then you bought it eventually to close the contract. Now, in order to do this, right? In order to do this, obviously you can't sell it you don't have. What the market forces you to do is, fine, you don't have it, no problem, but you want to sell it. You on paper will buy this security. Don't buy it for permanent. Just borrow the security from another broker who will allow this deal. So you can say, fine, I intend to sell, so let me borrow for selling. So you'll borrow it from a broker, right? And you tell the broker, listen, I'm borrowing it, but I'm going to sell it right away. So the broker will understand you're short selling it. When you sell it to a broker, potentially you receive some cash as proceeds, but you also have to pay a margin, right? You will then wait for the 1 week or 1 month to expire and buy the security at a lower price. But what the danger here is, suppose you went wrong, 1,500 became 1,600. Then you have no choice but to buy it at 1,600 and maybe pay a loss of 10,000. Clear? So in this case, you don't have an option to say, okay, no, I don't like buying it. No, you have no choice. If you have bought the share and you want to sell it, you have the choice to wait for it in 10 years and get the right price to come. But here, when you sold something you don't have a choice to wait for another 1 year, 2 years, or 3 years. You can say, no, I need to buy it back within 1 month or 1 week. You can't wait. That is why it's a very dangerous game where you short something, you can't wait to buy it back. And if the price goes against you, you still have to end up buying it back at a loss. That is a game of short selling. Okay. So you sell something you don't have by borrowing from a broker. You sell that through the broker, get the money. Then you buy it back and adjust the difference. The difference will be your profits, right? In this case, you do realize you will make money only if the market is bearish. That means the market falls down, right? But don't forget, if the price goes up, you stand to lose, right? So therefore, when the investor repurchases the asset later, he will obviously return to the lender. He will make or lose money based on the market price direction. Clear? So in a short position, you will make profits if it's bearish. In a long position, you will make profits if it's bullish. Are we clear? So are we now clear the concept of short selling? Now you're ready for the class? Yeah, very good. I hope you realize from what I explained that if everyone goes in the market and starts doing short selling, then the market is going to collapse. and then they'll make the profit by buying at low price. So that's a big risk and danger. Therefore, the market regulators and the market people make sure that people cannot just do random short selling and hammer the price. They will make sure that it is regulated. They will ask you to put a margin or deposit. They will also make sure that what you enter short sell is actually borrowed. You can't just imaginary say, I want to sell 1,000 shares. I'll buy it back. You can't do that. You have to literally borrow the shares and then sell it. Because if you start allowing you to sell without borrowing, then the markets will crash for the shares that you're short selling. Yeah. So borrowing and returning back, returning the shares is very important in the short selling. That is the way the markets control it. Okay. But in India, honestly, short selling is not very allowed too much because Indian mentality tends to be like arbitrage profits and so on. So they will hammer the market down and take it. So India has stopped short selling beyond a day, maximum 3 days. Yes, if you go to US and other markets, they're more developed and they're more functionally overseen. Their short selling is around because there they have a proper mechanism of borrowing, keeping in security, then selling it, then buying it back. Okay, so that's the concept of short selling. Good. So you realize now markets allow you to not make profits only in a upside. You can do it in a downside also. How? By doing short selling. Yeah. So what are key points to remember, which you already learned by now? You must ensure that you return it. You can't just borrow it, you have to return it as per the agreement. Right? You have to obviously give some collateral, right? You have to give margin because you don't forget the price might go against you. Then you may disappear. You may just leave the circuit. So they'll not go searching for it. They'll just take a margin from you. It will benefit only if the price goes down. If the price goes up, you won't get anything, right? Because you borrowed the shares. Remember, you borrowed it. You can't sit and say, boss, that dividend belongs to me. You just borrowed the shares. You not bought the shares. So the dividend will still belong to the buyer and not the short seller. Clear? Maximum loss, obviously, these concepts. In a short selling, your loss is unlimited because the share price may go up. But your gain obviously limited because you sold for 1,500. Let's say 1,500, the share price becomes zero max. So you will make 1,500 or more than that, right? So the gain is limited, but obviously your loss can be unlimited. This is very interesting. The broker who will help you to arrange the deal, he will get an interest in the collateral. And obviously, since he arranged the deal, he may also get a rebate from the short seller. He may get some commission, some brokerage. He will be the person who arranged the deal. He'll get some income from you towards arranging the deal. Clear? So there are key points of short selling. Remember, it requires margin, it requires deposit, it also requires a broker to be involved. Okay, leverage position. As the term suggests, leverage means where you're using borrowings to invest in positions. You want to buy shares, you don't have equity, fine, take a loan or take a fund margin, take 5 lakhs, borrow it, invest in 5 lakhs of shares. That's called leverage. Obviously, in such leverage, you'll have to put up some margin. Right? You can't just say, fine, in a house if you want, you'll always pay some deposit. That's called a margin. So every transaction where you have borrowings, you will have a concept of margin. On that margin, obviously, you will also have a interest rate. Here, now everywhere, even house property, you have 20% equity. You'll have to maintain a certain amount of margin. That equity is called your minimum maintenance. Okay. Now don't forget that if you have a position and you put equity, your margin, it is possible that position value went down. Therefore, margin value also goes down, and you have to pay the loss. So in that case, you will be asked. You will be made a margin call where to deposit extra funds. This extra funds only because you've incurred some loss on the position. Here was the leverage ratio. Very easy to understand. Is the value of position to the value of equity. Leverage ratio is also your financial leverage. If you remember the formula from earlier FS chapter, it is assets upon equity. So suppose I have invested 100 assets and out of that only 40 is equity, the other is debt. So answer is 2.5. So my leverage ratio is 2.5, indicating that there is high leverage, high borrowed funds. And how do you know the answer? Obviously 100 is a 40 is equity, so 60 is debt. 60 debt is a very high ratio, which is why it's 2.5. The higher the debt, the higher the ratio, and obviously the more unfavorable it is. The lower the debt, the lower the ratio, and the more the equity, it's a better position. Okay. So leverage position is basically to find out how much borrowings you have. The key ratio for financial leverage is A upon E. Please make a note of this. This was a financial statement analysis also. Okay. Now, obviously, from leverage, we can go on to consider margin trading. So, when you're doing margin trading, right? When you're doing leverage, when you're using borrowed funds, that's also similar to margin trading. What are you doing? You are putting up a margin, right? You are basically taking a loan. So, let's say you have $1,000, but you want to buy shares worth $5,000, right? Now, obviously, you want to increase your capacity to trade. So if I have, let's say, equity of $1,000, I want to borrow $4,000, which will allow me to trade in shares worth $5,000, right? So this is my game. I'm borrowing money to invest in shares beyond my capacity, right? Now this is a useful game. But what happens is, effectively, let's say this went up by 10%. Let's say it went up by 10%, right? That means you earn $500. But this $500 that you earn is not on 5,000, it's on 1,000 because your investment only $1,000. So you realize that effectively, obviously, you use the money to pay off the loan. You made a 50% return on your investment, right? You made a 10% of the original investment, but after paying the bank loan, need some interest. You can say I made 50 or 40% return. So you didn't make a 10% return. You made a 50% return because you have used leverage. Makes sense? Obviously, this is not always good because it could happen that this goes down by 5%. Your return, the loss will be 25%, not just 5%. So using margin trading has its own benefits and its own disadvantages also. Clear? So in margin call or transfer, what do? You borrow part of the money, right? You also pay interest. And obviously, see, suppose let's say I'm borrowing at, let's say 20%, just say a very high rate, but you're paying 20%, right? So 20% obviously is for a period of one month. So 20% per annum might be around, let's say, $200. You still made $300, just your 30% return. So even though I pay the interest on the returns I made, I will make 30% returns. Having said that, remember that what you pay here should always be less than what you earn. You may say I made 20% here, but I made a 50% here. But you should ensure that this number is always greater than the amount you pay. If you end up making not as much, if you end up earning a return higher than the borrowing rate, then that's amazing. You made leverage returns of 30%, 50%. But if you make less than the borrowing rate, you end up in a leverage loss. Clear? So you do realize margin trades are by people who are confident or certain of making a profit on their positions. Clear? Now, what is the leverage ratio? We already discussed it. It is assets upon equity, right? It's also equals to 1 upon the margin. Basically, the margin that you're putting. Because equity upon assets is a margin ratio, right? How much equity are you putting towards your assets? That's a margin ratio. So if you inverse the formula, it becomes 1 upon margin. That is also your formula for leverage ratio. Here, asset upon equity and equity upon assets margin. So the inverse of that is your leverage ratio. Clear, guys, the formula? So I showed you one example already. Let's do one more example. You guys try to attempt it this time. Look at the sum and tell me what is your analysis. Start. I want you to give me these numbers. So first one, try to attempt it twice. Remember, you're going to invest 40% and you have to maintain 25. Right? Now, 40% means 60% a loan. So when you invested $4, you had to pay around $6, right? The share became $12. So 10 became $12. So let's say this is the market price, $12. When the share became 10 to 12, what is the return you made on equity? Answer? What is the return on equity? Let's assume for
50%.
now there is no interest. Go on. What's your answer?
50%.
Very good. Well done. So I know I made $2 profit, but $2 was made on an investment of $4. So therefore, I made a 50% return, even though my stock went up only by 20%. Right? Okay. Now, so that was actually the scenario. Okay. Now let's say the stock went to $8. You notice that when you say $8, there also you end up having a loss of $2 on an investment of let's understand this, on an investment of 4, so 50%. Okay. Now look at the example. Let's say when the share value goes to $12, right? Remember your margin is 40%. Okay. So you have to invest $12 from 40%. So you agree that your equity will now become 4.8 and the loan that you're effectively taking becomes 7.2. Right? 4.8, 7.2. So you have to invest $12 effectively. Okay. So your return on equity might effectively reduce because you have increased your equity value. Clear? Same way, if the share value goes down, remember margin requirement goes down, but the margin value will also be reducing. So the value of the margin that you have, remember they will add to your profits and so on. So you'll have something a margin call. Let's look at the last part. What is the leverage ratio, guys? Leverage ratio. Answer. In the original situation, 10, you put $4, you took a loan of $6. What's the leverage ratio? Answer. Leverage ratio. Anyone? Come on, guys. Answer leverage ratio. Formula is A upon E. What is it? What is A?
2.5.
Good. A is the total assets I purchased. Equity is what I invested. So the leverage is 2.5, which means 2.5 times. Correct? Right. Now you do realize as the value of assets goes up, right? Right? Effectively, on that, your leverage ratio should ideally reduce. Correct? Now let's say the asset value went up to 12. Don't forget 4 becomes 6 because that belongs to you, right? Because you took a loan of only 6. So 12 में 6 का loan है, बाकी 6 is the equity. Look at the leverage ratio, 2.0 it came, which is good, right? It went down. But if the asset value goes down, let's say it becomes 8, your leverage, your value becomes 2. Look at the leverage ratio, 4. So what did you learn from this? Very important. As the asset value goes up, your leverage will go down because your equity is also improving, right? You made a profit, equity value goes up. But as the asset value goes down, your equity also goes down and you end up in a higher leverage position. Clear? Are we clear the logic? So leverage ratio is something which is immediately impacted by changes in the asset value. And that is why it's dangerous to have a leverage when you expect the asset value to potentially fluctuate or more so fall. Clear? Any questions? So this is margin trade. Obviously, we can look at then how the ratios are established. Look at this. Yeah. The share price goes up, rises, right? So then you'll end up with $12 and you took a loan of $6 upon 4. So 6 by 4, which is 50% return. I already demonstrated in the early example. So here you made plus 50, here you made minus 50. Leverage ratio, you only got the right answer, 2.5 in the two cases. Clear? Okay, so are we happy with the answer? And this is very critical. A 2 up or 2 down gives you 20%, but you're 50%, right? Because the leverage. I also showed you how the leverage ratio changes when the values go up or down. Okay, take a note of that. Please understand that this leverage ratio becomes 4 if the price goes down and becomes 2 if the price goes up. Correct? We discussed that also. If it becomes 8, it becomes 4. If it becomes 12, the leverage improves to 2. These are very critical. Okay, so remember, guys, in the world of CFA analysis, It's all about understanding the impact of changes or movement in price and so on. Understand, analyze the impact. That is what they wanted to do. Sure? Look at this example. He buys 10,000 shares. 10,000 shares on margin. Okay. He owns it for 1 year. Now look at the example. Purchase price, sale price. Margin 40%. Call money rate means the interest on borrowed capital is called call money rate. He has a dividend of 0.25 and also he has to pay commission of 0.05 euros. I want to tell me what is the return on equity. Also, your formula is returns divided by equity. Okay? So, what is equity he invested? What are the returns he made? And what is the percentage terms? Answer. Come on, guys. I'll give you a couple of minutes. Please solve the sum carefully and understand how to compute the returns on equity. Come on, guys. What's the answer? Anyone? Please think of the return. Now, if you think of returns, don't say returns is nothing but selling price minus cost price minus all your expenses that you incurred. Correct? And equity is nothing but the amount of margin, not margin, the amount of equity deposit, not the margin, the amount that you deposited for the shares. Right? You don't have to go in 10,000 shares, you can do it for one share if you want. Right? What is the margin that you paid on 40, on $50? How much margin you paid? 40%? Can I say my equity deposit is 40% of 50, which is euros 20? 20 euros? Right or wrong, guys? Is that a fair task? And what is the amount of borrowing? You borrowed 60%, which is 30. And USP you paid interest of 5%, right? So this is the interest that you paid on the borrowings, and it's for 1 year. So that means 5% of 1 year comes to 1.5. This is a payment that you made, correct? So this is a part of your expenses also, right? So now you compute for me. Obviously, you can add dividend amount also, right? So you can also say selling price expense plus dividend income. So you have the same price, 37.5. You have the cost, 50. You have the expenses, which is obviously don't forget commission also is expense. This is expense, and this is the expense, 1.5, right? Expenses has commission and interest, and don't forget you have dividend. So you have 5 elements. All you need to do is remove the cost, add the income, and divide by 20 euros because that is your equity investment. Start. Come on, guys, I'm going to wait for a few minutes to get the answer from you. What's the answer? Anyone?
So is it the minus negative 69%?
Negative?
69%.
Well, the answer is negative, but how much? I have to work it out. Wow, well done. Brilliant. You're spot on. Other people? Good. That also shows that you applied the task mentioned here. Okay, good. Other people? So the answer is indeed minus 69%. And like I said, I don't need you all to look at 10,000 shares. You can ignore this. Just look at these numbers. Assume it's one share. One share, 10,000 shares, same answer. Good. Really well. That shows you've understood the concept. So, like I said, sorry, I'll just rub out what I wrote. Like I said, look at the price we sold it for, 37.5. Then remove the cost, which is, sorry, it's on top, equity, right? Selling price cost. Now don't forget the commission amounts. The commission is what you pay. Commission is paid on buy and selling. So you should ideally make sure both are factored. Then don't forget you earn dividend and you also paid off the interest, right? So when you factor all of this, you will get 62,000 excess, which is your loss. So 62,000 is the amount of loss that you earn on a transaction, correct? Where the amount of equity that you put is 2 lakhs, right? This is obviously for 10,000 shares. This is the 40% margin, 40%. So 2 lakhs. Obviously, one small twist, and you may not have factored it, is that you have paid a commission of 0.05, which is to be added because even that is a payment you made as part of equity. So your equity is not just 2 lakhs, it's also 500. The amount of loss you made is only on your equity, it is 69%. So bear in mind, even though the loss from the sale is only 37.5 minus 15 is around 12.5. Effectively, now let's understand the cost was 50. The cost is 50. Selling price is 37.5. Right? So do you realize that you actually lost only how much? 22 point, no, 25%. Correct? You lost 25%. 50 to the it's 25%. So a decline of 25% has given you a decline of 69%. How bad is that? So in this example, a decline from 50 to 37 is 25%, but your overall return is fallen by 69%. And this is the danger of leverage. Obviously, if it had gone up by 25, you'd have been happy by 69 also. So remember, it plays both ways. But what I'm going to explain to you here is leverage basically enhances your profit and your losses, and therefore the game is to be played carefully. Yeah, I hope you got the maths right. The rest of it is quite simple, right? It's about the equity component that we're looking at, right? I'll show you a good example on margins also, because margins is an essential part of your type. So we discussed initial margins, what you initially invest, and obviously maintain margin, what you should maintain. Now let's understand how does margin trading really work. Okay, we'll do a last one and then we'll pause for a break because we are continuing the margin. So let's say you bought at $20 and you sell at $60, $50 and 60, sorry. So if you were to buy somewhere 50 and earn 60, you're making $10, but that is around 20% profit. But if you did a margin trade, right, this 20% profit that you made is enhanced to 40% if you do the same thing by putting margin, right? If you put full money, you got 20%. But if you borrowed some money, right? When you borrow, what do you need to do? You need to put a margin, right? When you borrow, you say, boss, let me borrow 50%. The other 50% margin. So effectively, you invested only 25, correct? The other 25 will be borrowings. Then in this case, the amount of returns that you would have made, which is $10, when you divide it by 25, you will now get 40% return. Here, so look at how your margin, your profit is being enhanced because you took a 50% margin. Here, 50% margin, your profit becomes double. If you took a 60% margin, your profit becomes 45 or 50%. So margin increases your profit. Here, obviously, same scenario, same numbers, but I'm dropping it down by $10. You see, the amount is exactly identical, but I have a loss of 40%. So a loss of 20% original has become a 40% loss because I took a margin. So this is the same example to show you how having a margin will literally double your profits and double your losses. Yeah, I hope the example is working. Yeah, and this is where the real market makes sure that we don't run away from it. So we have something called as a margin call. Now what's a margin call? A margin call is basically where the margin you invested may go down below a certain maintenance amount. So let's say you put up a margin and you have to maintain the margin. If your margin goes below a certain level, then the stock market will call you and say, boss, you need to now deposit a further amount. And that is called variation margin. Clear? Now, quick example. Let's say you put up $100 margin, right? Now this $100 will probably be adjusted. Every time you make a loss, let's say the value goes down of what you put, then still keep adjusted. But I am saying you need to maintain at least $70. Okay, now learn carefully. This is initial margin and this is maintenance margin. Now, obviously, the $100 might become 90 because you lost $10 on the transaction, 80. So they'll keep adjusting. The moment it becomes 70, the moment it touches 70, let's say it became 65.
right? They will immediately call you and tell you to invest from 65, they'll ask you to invest $35 to bring back this margin to the initial margin. To bring it back to initial, they will not tell you put up $5. They will tell you invest 35 and that amount is called variation margin. So variation margin brings back your position, brings back the position in the account to actually initial margin. It brings back the position back to original amount. Clear? So we have three margins. Initial margin, which is what you put. Maintenance margin is what you should maintain. And variation margin is the amount that you invest to bring it back to initial margin. Clear? Okay, these are very important concepts. And obviously, now let's say you don't have $35. You can't pay. No problem. The stock market said, fine, get out of the market. Show the question. The stock market will either sell your security, will obviously you can sell. You have a choice. Say sell security. You can put more cash or you can put more security. You can do three. You can either put $35 more, or you can give more shares with $35, or you can say, boss, I'll put some cash. If you can't do any of those three, the market will throw you out. It will square off a portion, close the deal, and close out whatever you have and pay the balance to you. Clear? So if you want to remain in the market, you have to maintain and pay the variation margin. So if you look at the example, I told you that when the price becomes 70, you'll be called for a variation margin. It goes to below 70, right? Now, that price is a certain price which will trigger the variation margin. If I want to know when will that price be triggered or when will that price call me for a variation margin, there's a formula for it which you need to learn carefully. It's a very important formula. This formula gives you the trigger price at which your equity will fall below maintenance margin. So you have put in an initial margin. Equity means your initial margin. That amount may fall below maintenance at a certain trigger. What is the trigger price? The formula is the price at which you transacted into 1 minus initial margin upon 1 minus maintenance margin. If I put this formula, I will get the price at which my margin will be called. Clear? I'll show you an example later in the next slide. But if you're in a short position, obviously remember short is where the price will fall down, you'll make a profit. So in a long, your trigger will happen when the price falls down. In a short, the trigger takes place and the price goes up. I hope you know the answer, right? In a long, the price falling is bad. In a short, the price falling is good for me. The price going up is bad for me. Therefore, the formula is plus. So here it is minus because I'm losing money when it falls. Here is plus because I'm losing money when it goes up. The variables are the same. Are we clear? So this price is the price at which you will get a margin call. This price is the price at which you get a margin call, but this is for a long and this is for a short. Are we clear? So this is for a long position. So first decide, are you in a long or a short? If you're in a long, put the formula as 1 minus. If you're in short, put the formula as 1 plus. Clear, guys? Okay. Last example, let me take a quick break. You guys are tired. Okay, so let's understand how to play the margin call example. Look at this example before you. Let's say I bought a share price for $100. I'm supposed to maintain 50% margin. So what is 50% 100? $50, right? And they're also saying that you should maintain 25%, right? What is 25% margin? Which means that I should maintain, it's the maintain margin 25%, which is based on that. So this is my initial margin and this is my maintenance margin. Okay, 25%. Okay, now look at the formula here. What he said in the earlier example, the formula is price into, it is long, so 1 minus IM upon 1 minus MM, right? Remember, it is minus sign. So what I did, price 100 into 1 minus IM is 50%. 1 is mm, which is 25%, right? When you put this formula, you will get 66.67. Now, understand what that means. That means if the price of the share falls to 66.67 or below, you will get a margin call, right? Now let's check if it's working. This is what I was looking at. Now you know that the margin you're putting is $50 and they are saying you should maintain at least 25%. Okay, 25%. What is 25% of $15? What is 25% of $15? $50. It is, so 25 50. So 50 is 25. So it is how much? 12.5 effectively, right? 33 points. Yeah. So let's look at the sum of the price. When the price is 100, right? Your margin, what is your margin out here? Okay. You put a margin of $50, correct? I'll give you X scenarios. Let's say the price becomes 90. How much will your margin be worth? 40? Because now your margin is fallen, they have adjusted the loss against your margin. If the price becomes 80, your margin becomes 30, right? If the price becomes 70, 50, 40, right? Your margin is adjusting for the fallen price, okay? 70, your margin becomes 20, and so on. When the price becomes 60, the margin becomes 10, okay? Now, what is 25% margin? It is somewhere between your 25% margin, right? And effectively, that point is 66.76. So basically, when your margin becomes 66.6, that means your price became 66. So that's 20.
So I have a doubt.
Yeah.
So if the price fell 10%, right, 100 to 90, so my
90.
margin would also fell 10% of my margin, right?
No, not 10% margin. Your price fell by 10%, which means what is the loss you made? What's the loss? $10?
Yeah.
This $10 will be recovered from your margin. They will adjust your margin by $10. They will say, boss, you have deposited $50, right? So they'll adjust the loss against the deposit. This deposit is nothing but a protection or equity. It's a funding that you give it. So your deposit will not go down by $10, 10%. It will go down by exactly $10.
So it's the price, not the percentage.
Correct. Okay. Now, basically, when the price falls down to around 90, 80, 70, the price of shares, okay, when it falls to 66.67, your margin becomes 16.67. Effectively, at that point, you will be called to make a variation margin. Because at that point, your margin has dipped to 25% or below. This is on the long side. Now, obviously, don't forget, your margin is being adjusted simultaneously. Your margin is being adjusted simultaneously. Now, you want to check the proof? Let's see the proof. Let's look at this point. You tell me, as 66.67 answers question, what is 25%? What is 25% of this amount? Answer. 25% of this amount. Answer. 25% times 66.67. What is it? On the calculator, it is 16.67, right? 16.67 is exactly what you maintain at this point. So when the margin that you maintain fell to 16.67, they will call you up and ask you for variation margin. Is that clear now? If you want another proof, what is 25% of 90? It is around 22.5. What's your margin? 40. So you're sorted. What is 25% of 80? It's 20, but you're at 30, so you're sorted. What is 21% of 70? It's around 35, 17.5, but you have 20, so you're sorted. It's only when you fall to 66 that your variation margin, your margin is equal to the maintenance margin. So they'll say, boss, below that point, I will trigger a variation margin. Does that make sense now, guys? Does that make sense to you? Or you ask a query also? So remember, my losses are reducing my margin. When my margin becomes exactly 25% of the price, that's when I will get a wake-up call. Is that now clear or not? Yeah. I will prove this to you with a short question also. I will clear the long question. Now let me show the same example to you with a short question. I'll show you more detail here. Okay. So in a short position, right? The answer is 120 by doing the maths. 100, 1.5, 0.25, 120 is the answer. Let's check. Let's check. Now you guys tell me, okay, I'm going to look at share price. Share price is, let's say, 100. Now you know that if the share price increases in a short, you make a loss. So let me prove to you three situations. What's your margin? Your margin is 50, correct? We started with that. Now let's compute loss and then net margin. Okay. When the share price was 50, obviously no loss. When it became 110, what is your margin becoming? Your share price increase, so your margin, you have a loss of $10. This loss will be adjusted against the margin, right or wrong? So now your margin became $40, right? Now tell me, what is the maintenance margin? At 100, it was 25, right? But at 110, what is the maintenance margin? 25% of 110, which comes to how much? 27.5. But, your net margin is 40. Your maintenance margin is 27.5. Are you sorted? Yes. Right or no? Your 40 is greater than 27.5. So you're okay. Let's come to the next scenario. 120, you have a further loss of $10. That means this 40 has now become 30. Fine. What is my maintenance margin? 25% of 120, that comes to how much? Comes to how much? $30. Now $30 is your maintenance, $30 is your net margin. You are in the same scenario. So if you go further up by 120, your margin will fall down and your maintenance margin is higher. You will be getting a variation margin call. That is why 120 is the right answer. Does it make sense to you now? If I went to 121, this will become 59 and this will become 31. You are in a wrong position. You will have to pay for the maintenance. Does that make sense? Is it clear now?
Yes, sir.
I hope you understood the settlement procedure and I hope that that question you asked is resolved. That when I lose money, my margin goes up, goes down with the same amount. In the same case, in the long portion, when the share price is going down, my margin is going down. But don't forget your maintenance margin also is going down. The moment your maintenance and your net margin are same, that becomes a trigger point. Clear? And that's why this entire maths is explained. So in a long, it's 66. In a short, it is 120. Any doubts on this? So I hope I proved it to you through a table and you got the maths with the formula. Also, my formula is more critical out here. And that's how it goes. Clear, guys? Okay. So use this later in your video lectures to understand why the margin call is happening in such an erratic manner. Right? This is the same example we discussed. Okay. If you guys solve this quickly, let's solve this answer and we'll break. You bought a share at $10, so the share price is $10. The margin is 40% and when is 25%. So what share price do you think you will get a margin call? Come on, solve it, guys. Solve it for me. Don't do that sum.
So 8.
8. Okay, very good. That's right. So quickly, if you do 1.4 and 0.25, the answer is 8. Right? And let's check the maths. Okay, let's see the price. You are at 10, obviously you'll make a loss, then the margin will fall down. Correct? What's the margin? You paid a margin of 40%. So your margin is $4. Right? What's your maintenance margin? Okay, now maintenance 25%. So your maintenance margin, this is your initial margin. Maintenance margin is 25%, which is 2.5. So you are sorted, right? So there's no problem. When it becomes 9, the one loss is reducing this to 3. But what's your maintenance margin? 28% of 9. That is 4.5. That is 2.25. You are still above, so you're sorted. When you come to 8, 10 became 4 became 3 and 4 will now become 2. What's the maintenance margin? 25% of 8, which is 2. At this point, both are same. So here the trigger takes place. Correct? And the proof. If 8 becomes 7, 2 becomes 1, and 25% of this is around 1.75. So notice that the margin is less. So you can't reach this situation. This is not possible because you might run away. So what they'll do at this point, they will trigger it because at this point, your share price, if it falls further, your margin becomes lesser. So got the proof? Okay, and this is exactly how they operate the margin requirements. The margin keeps decreasing as the share price falls. You will be required to call up at a certain price, and that price is known by the formula which I showed you, P into 1 minus IM upon 1 minus NM. Yeah, that's a proof. The answer is 8. Good to go? Okay, sure.
So just a question.
Yeah, tell me.
In the solution, we need to give the equity position as well.
Equity position.
Yeah, so 2 divided by 8. Because I think in the solution it was given. Yeah.
Okay, no, that is not a solution. That was another question. What you're saying that it was a proof. Basically, it's not a solution. When you reach 8, what is your equity position? 2. At that stage, what is your leverage? What's your maintenance? 25. And this is exactly what you need to maintain. So this only to prove to you that when it became 8, your margin became 2, you ended up with a margin of 25, which exactly is equal to your maintenance margin, and therefore a trigger has come. Understood?
Yeah, okay.
So this only to demonstrate that at that rate your margin has become maintenance margin. Yeah.
All right. Thank you, sir.